Well, hello and welcome to Breakout Trading Answered, the show where we talk about all things breakout trading. And today we're going for a trip. We're going for a trip to Europe with our tour guide, Thomas Nessler. Oh, welcome, Thomas.
That was quite an
That was
introduction.
crazy.
Thank you and welcome back. Yes.
Now, I need to
That's true,
explain why I
guys.
said that, right? We're not actually going to Europe. We're talking about the European markets, and I probably should have said that first. So hopefully now all is clear. Let's get started.
Fantastic. Just phenomenal. Okay. Thank
Oh,
you.
dear.
Quite an
That's
introduction. That's true, guys. We're going to talk about European markets, and not just because I am a European citizen, but because you'll see it's quite profitable. So let's talk about another opportunity where, guys, you can make a lot of money. And I have to say, European markets are being overlooked, and that's not fair. Again, not because I'm a patriot, because these markets are, first of all, damn good. And second, especially traders in the US, they can make money while they're sleeping, because European markets trade during the night in the US. So there's extra opportunity to leverage your money and keep making money around the globe. How fantastic does this sound?
That sounds brilliant. So before we get into it, though, this is part of a three-part series, I guess. I'll just skip the slide here. So in the last two episodes, we talked about the best E-mini S&P 500 strategies and the NASDAQ strategies. So this is a continuation of that into European strategies.
And by the way, guys, you let us know if you want us to cover some other markets, some other sector, okay? These are the most favorite one, S&P, NASDAQ, and also Europeans is something you need to know about, but if you're missing something, please let us know. We can prepare another part of the series.
Yep, absolutely. So as you mentioned, we're going to be talking about European markets. Which ones are we going to focus on, Thomas?
So we're going to focus on three markets. The biggest potential you can get in these European markets, which are FDAX, FESX, and FGBL. So FDAX is super volatile market. And I can tell you in FDAX, in DAX, it's a European market. It's DAX, I'm not sure now whether it's 30 or 50. I think it's 50, top 50 European stocks traded in Germany. And I can tell you, you can make way more money on DAX than on crude oil, and crude oil is already quite an animal. We're going to talk about FESX and FGBL. FGBL is actually futures version of Eurobonds. So it's a bond market, but it's got a very high liquidity. It's very tradable. And FESX is called Euro Stoxx, double X. And I think FDAX is 30 stocks, and FESX is 50 European stocks. So it's similar to, let's say, Dow Jones, which is more like DAX, and FESX, which is more like, let's say, E-mini S&P, and FGBL, which is more like USD bonds, the US symbol. So this is just the European version. And I'm going to talk again as a part of this series. In every part, I'm going to show you some true out of sample performance. And I'm also going to share with you what I have learned, so you can reapply my findings and you can start profiting on these markets as well.
Exactly. But before we get into it, if you want to thrive in trading, maximize your profits, and learn how to create a fully automated trading business, remember to hit subscribe and the like button, and you'll be notified whenever we release new content. Okay,
so let's get
to
to it. Right. So as always, all the strategies that I have developed on European markets have been developed according to this model. That's the only model I use, the Breakout Strategies model, which you can find more about on the breakoutstrategiesrevolution.com. Very simple model, working just with 4 components: point of initiation, time, space, and filters. So I leave it up to you. We already discussed this model in this show as well. So there's plenty of material, including this book. Let's now get to European markets and what you can expect. And let's start with DAX. So as I said, DAX is a wild animal. DAX is a very volatile market. It's called to be the market for big boys. because I can guarantee you can make in this market more money than in crude oil. And everybody trading futures knows that crude oil and NASDAQ, that's where the money is. And you can make actually more money in DAX than in crude oil and probably NASDAQ combined. That's how crazy and volatile this market is. But you also have to work with a pretty big stop loss. Fortunately, there is also a mini version. So if you're not capitalized for a volatility like this, you can definitely use a mini version. So I believe this market is for everyone. And I want to show you, to me, this is really crazy. So this is a strategy on 60 minutes. It's a swing strategy. And it trades all 24 hours time frame. That's another beauty about European market. So this market start trading 7:20 or about 7 a.m. European time, and then they trade until 10 p.m. European time, because once the US session starts to trade, basically they will catch up with the US session, and they trade, these markets trade during the European as well as American main trading session. So we're talking about 14, 15 hours of trading non-stop. For algorithmic strategies, this is crazy. And that's why you can see something very unusual here, which you probably will not see on any other market. It's very hard to see this on any other market. Can you spot what it is, Andrew?
No, I'm not sure what it could be. You want to give me a clue?
Yes.
I'm not sure where to be
Size?
looking.
Sample size? Sample size?
Well, it looks like loads of trades, but I don't see a number of trades on the screen there.
Yeah,
Unless
it's on
I'm
the
missing
chart.
it,
Yeah,
but-
it's a little bit hidden.
Oh, it's
yeah,
on the
it's
chart,
on the
yeah.
chart. So
Yeah.
so it's over 3,000 trades, over 3,000 trades, and it's a little bit over 10 years. So that means this strategy trades, even it's a swing strategy, it trades almost every day. That's crazy. And with this strategy, which trades almost every day, you still have average trade profit after slippage and after commission $83. This is after transactional cost, which every more experienced trader knows that it's almost impossible to trade every day and have a good quality average trade, because then with a higher frequency of trading, the average trade goes down pretty quickly. So that's quite unheard of. That's very specialized. That's very different about these European markets, especially DAX. I believe that DAX is one of the few markets, because of its volatility, where you can really trade with very high frequency, and on short trades you can still have a very, very good average trade, which again, it's difficult to achieve on any other market. Maybe NASDAQ, it's quite volatile nowadays as well, but still the average trade can be very, very high. Now, the other interesting thing is that it doesn't require much of a complexity to create a strategy on European markets. And the reason is because for and E-mini S&P, and I don't know, traders are for some reason super conservative about this and super reluctant to explore other options. Now have a look. This strategy doesn't use strategy for long and short, and it does use more advanced point of initiation. I think this is some kind of adaptive point of initiation, and it does use a trailing stop loss. It's not visible here, but when I checked in the database, it uses a trailing stop loss, but no filter at all. You just enter on a breakout level, and then you keep trailing stop loss until you get out. That's it. Very simple. Again, it's quite difficult to achieve a strategy like this on US markets, where obviously there's a bigger war of algorithms, and the efficiency of these markets it's way more difficult to achieve something like this. So I think this is quite brilliant. although you have to work with much higher stop losses. As I said, it's a very, very volatile market, or you need to trade a smaller mini version. To me, this is quite impressive.
Yeah. So for those who didn't see the last 2 episodes where we talked about S&P 500 and Nasdaq, can you explain what this blue box is under the chart where it says risk? What is that?
Right. Yeah. Let me quickly. So first of all, the vertical line, that's the true auto sample. So that's when the strategy was developed, and since then we can see true auto sample performance, which I think it's quite amazing. It just goes pretty aligned with the in sample. And then the blue big box below, it's actually risk. So we cap the risk with a stop loss, and the stop loss here is $3,000. So you can see. Sometimes the risk is lower because so the trailing stop loss actually trails based on true range, average true range, so based on volatility. And you can see that sometimes the volatility is lower, so even $3,000 stop loss would be too much, but with most cases we have to cap the stop loss in terms of dollars by this amount of $3,000, because it really is a volatile market. Doesn't mean though that these stop loss is triggered each time when it's a losing trade. Not at all. That's just a protective stop loss.
Yep. Okay. Thanks for explaining that. So that's a pretty neat strategy. Sounds like it's really very basic. No filtering.
Very basic. Yeah.
And it's performed
I would say
in true out of sample.
We have more advanced risk management. Obviously, we have this trailing stop loss, which also proves that sometimes the exit and the trade management, not so much risk management, but trade management can very well substitute any kind of filter. I know that traders, for some reasons, are obsessed with filters, but in many cases, you don't even need a filter. You just need a good, savvy trade management, and that can do the job very well as well.
Some traders are not going to want to hear that, are they? They love filters.
Yeah, I know.
What's the latest filters, Thomas?
Exactly.
Yeah. Okay, so that's a good example. Do you have any more to talk about, or do you want to move to the next one?
Let's move to the next one. So the other markets, the Euro Stoxx 50, compared to DAX, I think it's already a little bit more boring trade, a little bit more boring market. But again, it's tradable. It's not my favorite, I have to say. This is just an example what we can do. It's tradable. This is another swing strategy, 80 minutes charts. This is regular trading hour of the European exchange. So this is the European time only, long, short, both sides. And again, the stop loss is quite big. The reason is because this strategy doesn't overlap the US sessions. It basically stops trading 2 p.m. European times, and the markets open 3:30 European times. So there's a gap. There's something like a overnight gap in markets in the US. There's a gap like this European afternoon gap session and gap from this session. So that's why we have a little bit higher stop loss, and there is a higher risk because there is this gap. And this strategy is not as fancy as the previous one. But again, it's quite simple. We again have some fraction long short. We again have trailing stop loss, which is not visible here, but I can tell you that it's trailing stop loss. And here in this case, we have a simple filter. We have a very basic point of initiation here. I don't recall exactly what it is. I think something like open of today, something like this, or close of yesterday. Very, very basic point of initiation, nothing fancy, very simple filter, and trailing stop loss. Overall, it looks like trailing stop loss works very well in European markets. And I suspect that that's my kind of observation. that in European markets, we have less of these with zigzag, how you say it in English, very complicated word for me. Like, like zigzag intraday movement. The intraday movement is a little bit cleaner compared to the US because, again, it's obvious there are not so many algorithms deployed yet. So that's why trailing stop loss is a little bit more efficient in European markets because we have less of these fake counter moves, which would get us out too early on trailing stop loss. So that's why we can be more efficient with trailing stop loss in these markets.
Yeah. What's interesting in this one is in the risk part of the chart, which is the bottom part, you can see, so what is this, a $3,500 stop? You can see that, a lot of the trades don't even get up to 2,000, but then every now and then you get a nice little gap, and there's one that looks like it's over 4,000, maybe $4,500 loss. So it's quite interesting to see that the majority are well below 3,000, and then a couple every now and then. So you've got to be careful of gaps. You're not always going to get out at the stop price you want to get out, right?
Exactly. Great observation. Actually, you can see that the actual risk is very low. It's probably a couple of $100. And you can see also the profit of this strategy is nothing to write home about. It's 1/10 of what we had in the DAX. So the actual risk is very low. This is not a super profitable market. This market is quite boring. But because of these gaps, we might need to hold on a bigger stop loss, which again gets triggered actually very, very rarely.
Yep. Okay. So that's a good example. And the next one I think is FGBL, isn't it? Bonds?
Yes. So next one are Euro bonds.
Yep.
FGBL. One specific thing about this market is insanely liquid. The liquidity of this market is through the roof. So you can easily trade tens of thousand contracts here, even tens of thousand contracts. This is a strategy, again, swing, 90 minutes, regular trading hours. Again, it's similar story like with FESX, the Euro Stoxx 50. We have a big stop loss here because of the overnight gaps. What you can see really on this chart is quite interesting. If you look at the end of this chart, the interest rates changes, which were equally increased in the US as well as in Europe, really impacted this the risk of this strategy quite a lot. So reasonable couple of higher interest rates, there is higher volatility, and we can see a big increase of overall volatility. But this stop loss, which again is mainly for the sake of mitigating gaps or just managing the risk of gaps, this higher stop loss still can deal very, very well with these days of increased volatility. And overall, again, no filter, not even a complicated point of initiation. This is extremely simple strategy. This is really, again, just fraction long, fraction short, trailing stop loss. That's it. Super, super simple. So, guys, you do not need fancy filters. You just need to know the market. You need to know what works there, and you do not need to overcomplicate it. And again, the out of sample is very nice compared to in sample. So this proves my theory that these European markets are still way less cluttered with the war of algorithms. And that's why it's probably easier to develop quite simple strategies there, which seem to hold reasonably well in true out of sample. Another reason why I definitely would recommend them. And I'm going to dig even deeper into them because last few months I spent a lot of time exploring some tendencies in US markets, and I found quite a few interesting tendencies. I suspect that we can find in European markets even clearer tendencies, more obvious, due to the fact that the world algorithm is still not raging so much in Europe as it is in the US, on US markets. So it's a great diversification. It's a great opportunity to trade while people in the US sleep and cannot or do not trade because of the night session.
Yeah. So that $3,500 stop loss, was that set at the vertical blue line, or is that a recent adjustment based on the volatility?
That was set with the blue vertical line.
Okay.
There's no adjustment. So this is exactly, all the parameters are as it was when the strategy was developed, which actually surprised me as well. It's holding still very, very well, isn't it?
Yeah, I'm quite surprised. So if that volatility gets even larger and you start getting the stop hit more often, would you consider changing it?
I would, yes, I would. But we have to bear in mind that in these cases, the stop loss was set, it was really set as a protective stop loss. Let's say it was a kind of stop loss when you're deciding either I will not put any stop loss at all, which I would never ever do, or I will just have a look on my maximum adverse excursion chart, and whatever the highest value is, I'll have at least something protective there. So this was this kind of stop loss, which I think is obvious from the risk chart, because the vast majority of trades, the maximum adverse excursion, it's nothing. It's a couple of $100. So it's really like a worst case protective stop loss.
Yep. Okay. So then I guess the key takeaways of those three examples.
Well, Euro markets, and let me clarify, Euro futures markets offer great potential.
Yeah.
Period.
Yep.
You're depriving yourself of a good opportunity if you do not consider them. And by the way, these markets are very, very approachable or reachable, or how would I say it? Because you can easily trade them with interactive brokers, TradeStation. Actually, with any good broker, you can trade these markets easily, because these markets are now offered worldwide. So the data in TradeStation, all the data I have from TradeStation, easy peasy. Should be very easy for you to start developing on these markets. It can be simpler. This is one of the simplest experience in market development I've ever had on European markets, but definitely with more dynamic, not so much exits like trade management. That's what seems to work best. And as always, long short need a different approach. It is a skewed market. There is a bias, same like in the US. So there's a skew. So that's why we need to treat differently both sides. But overall, just try it.
Yeah. Well, there's some really excellent examples and some great takeaways you shared with us, Thomas. So thank you. And I'd just like to encourage everyone to hit the subscribe button if you want to thrive in trading, maximize your profits, and learn how to create a fully automated trading system business. Thank goodness that's the end of the show. So, Thomas, any closing words before we wrap this one up?
I think I summarized it, guys. Open your mind, explore the unexplored, and if you like this episode, don't forget to give us a thumb up. It will help us a lot, and we will know that you're enjoying this show, and it will give us the inspiration and motivation to keep going.
Exactly. So thanks everyone for joining us today, and we'll catch you at the next one. Happy trading.
Happy trading.